More now on those weaker than expected earnings and outlooks from a host of big retailers today. First, a look at how their shares performed. Dick's Sporting Goods tumbled by 17%. Staples was down 12%. Clothing chain Urban Outfitters down by almost 9%. TJX, the parent of TJ Maxx and other discounters, fell by 7%. Bucking the trend today was Home Depot. It was one of the few Dow components that closed higher today. Courtney Reagan has a roundup now for us on the latest chain store earnings, and she tells us what's pressuring consumers and retailers alike.
From printer paper to crop tops to golf clubs, it seems anyone selling anything is struggling these days. Staples reporting weak sales, traffic, and a nearly 44% drop in profit as consumers buy more of their office supplies online. TJX, the owner of off-price stores TJ Maxx, Marshalls, and Home Goods, says sales of apparel has been weak, and as a result, the retailer cut its earnings forecast. Dick's Sporting Goods also cutting its profit and sales outlooks after weak first quarter sales for golf and hunting gear. While weather certainly was more severe than normal in the beginning of the year, it doesn't explain everything. Some of the broader issues consumers are grappling with include stagnant wages, a still tight job market, and a housing market that hasn't shown consistent signs of strength.
I covered the specialty apparel retailers, and there was a lot of problems as well with the fashion in the marketplace and it just not resonating. And then you layer onto that traffic issues. No one was going to the mall. The customer wasn't inspired. And we're seeing the results, out there now. It was just not a good quarter.
There are also internal factors at play for some retailers. Target and American Eagle are both working with interim CEOs. Lululemon and Coach have new CEOs getting first quarters in the books. But there have been pockets of positivity this retail earnings season. While Home Depot said weather was the main culprit, causing sales and profit to fall short of expectations, its chief financial officer classified May sales as robust on the earnings conference call, adding the retailer isn't seeing evidence of a softening housing market. Beleaguered department store JCPenney surprised Wall Street to the upside with nearly every metric, including traffic and sales. But most analysts believe retail is a tricky area for investors as it's getting harder to predict which names will be winners. For Nightly Business Report, I'm Courtney Reagan.
Michael Farr joins us now to talk more about the markets and what investors should be doing with their money. He's president of Farr Miller and Washington. Hi, Michael.
Hello, Susie.
All right, so with all this Fed speak today, it looks like interest rates, I don't know when, but they are going to be going up. When that happens, what does that mean for the direction of the stock market, and what does it mean for investors and their portfolios?
Great question, because we've seen the stock market kind of take a head fake from previous Fed warnings. A year ago, when Bernanke talked about the taper, the Treasury market and the Treasury yield went way up and the Treasury bond fell off and stocks didn't like it very much. Once they began the taper, of course, Treasuries rallied, yields fell, and the stock market has seemed to like it pretty well. So I'm wondering if perhaps we're not seeing a bit of a repeat. They're now talking about hiking rates and stocks are pulling back. I think we might have a different experience when indeed rates start to rise. Overall, they're looking at the slack labor market, is what Bill Dudley said in his comments today. And as long as there's slack in the labor market, and they're not seeing any real wage inflation, then we don't have other inflation. And the Fed will, I think, probably stay on the sidelines for a long period. Stocks will have some more room to the upside. Stocks are also one of those asset categories that tend to appreciate and act as a bit of an inflation hedge. So investors kind of once again have to ignore the noise in the fish market and pay attention to the price of fish.
As the tapering continues here, Michael, and the Fed keeps pulling back on the number of bonds that it buys in the Treasury market and the mortgage market here, do you think the economy's where they thought it was going to be? Housing still not reviving as much as we all thought it should. Retail, we just hear they had a lousy first quarter this time around. Interest rates and inflation are not picking up to any great degree right now. What's going on? What do you think the Fed's thinking about right here?
Bill, I think it's an excellent question, and I think the Fed is in large part puzzled. I mean, they have created this balance sheet over $4 trillion. We've had over $6 trillion in deficit spending over the past 6 years to generate 2% GDP growth. So for all of this stimulus everywhere, we haven't really been creating that many more jobs. We haven't seen the economy rebound in terms of organic demand pull. And what we really saw out of Walmart was they told us that the Walmart shopper, which is middle America, the Walmart shopper doesn't have more money to spend. So when your GDP is 2/3 consumer and the consumer doesn't have more money, you know, I think they're a little confused that they haven't seen inflation yet.
Right.
They're biding their time, but they'd like to see it.
Let's get some advice from you for investors, Michael. What should investors do with their portfolios? Are you changing your investment strategy?
We never change our investment strategy, but I think this is not a time when the market's making new highs to take on additional risk. So I think multinational companies with solid balance sheets, good, clear market share, good, strong cash flow, and not too much debt, and a good little bit of a dividend on the side make a whole lot of sense to me.
Can you give an
defensive.
example? Give a name of one stock at the top of your list.
Yeah, Johnson & Johnson has been a favorite of mine for a long time. The stock is in the mid-teens in terms of a PE multiple. They have a AAA balance sheet, a 2.6% dividend. I mean, you make as much money or more on a AAA balance sheet from Johnson & Johnson than you do on the U.S. Treasury, which is no longer AAA. I think it's a good way to go.
Makes a lot of sense. Michael, thank you so much. Michael Farr with Farr Miller in Washington.
Thank you.